8.9 billion euros. Just let that number sink in for a second. That is the pro forma EBIT, the operating profit generated by the energy giant Eni in just the first half of 2026. It is a genuinely staggering amount of money, and honestly, it perfectly sets the stage for what we're going to explore today. We are looking at a legacy energy titan operating at the absolute peak of its powers, all while navigating what is arguably one of the most complex industrial shifts in human history. Welcome to The Explainer. Today, we're decoding Eni's H1 2026 financial results. But look, we are not just going to sit here and read through a dry spreadsheet. We're looking at this through a really specific framework, the dual engine strategy. See, on one side, you have a highly profitable, traditional fossil fuel business. On the other, a massive, capital-intensive transformation toward green energy. How do you balance both of those without stalling out entirely? Well, that's exactly what this report reveals. Okay, let's dive into this. Here is our roadmap for today. First, we'll be unpacking the H1 2026 financials. Second, Engine 1, traditional energy. Third, Engine 2, the transition. And finally, cash flow and future guidance. All right, starting with Section 1, unpacking H1 2026 financials and looking at the big picture of Eni's value creation. Now, right out of the gate, they reported a massive net profit of 3.6 billion euros. But net profit doesn't really tell the whole story when you're running an industrial machine of this size. Eni reported an adjusted CFFO, that's cash flow from operations, of 7.3 billion euros. Why does this actually matter? Because CFFO is the cold, hard cash the business is generating day in and day out. It is the absolute lifeblood of this entire dual-engine narrative. It's literally the cash required to fully fund their massive capital investments for the future while still paying out dividends to shareholders today. Now, what's really interesting is when we break down exactly where that money is coming from, because the dynamic is fascinating. The traditional exploration and production sector brought in 5.3 billion euros. Compare that to the global gas sector at $500 million and transition businesses at 0.6 billion. It totally highlights that the legacy fossil fuel sector is absolutely doing the heavy financial lifting right now. I mean, it is the cash engine driving literally everything else. Moving on to Section 2, Engine 1, traditional energy. Building a world-class E&P business. You know, it's really easy to get lost in abstract billions, so let's ground this in reality. Take a look at the Nagua FLNG, a floating liquefied natural gas vessel deployed down in the Congo. This thing is essentially a floating industrial city. The sheer scale and the engineering feat of this single asset is just breathtaking. This is exactly what Engine 1 looks like in the real world. Eni is maximizing its legacy upstream oil and gas assets all over the globe, creating this tangible, colossal infrastructure that secures energy supplies while, printing the cash we just talked about. And they aren't just relying on old discoveries either. Their exploration teams are having a phenomenal year. In Côte d'Ivoire alone, they discovered 5 trillion cubic feet of gas initially in place, plus another 450 million barrels of condensate. Then you combine that with massive discoveries in Egypt, Indonesia, Libya, and Angola, which alone added around 500 million barrels of oil originally in place. To translate the industry jargon for a second, they are finding massive, massive volumes of new resources across a highly diversified global footprint. It's a huge deal. But actually finding this stuff is one thing. Getting it out of the ground, that's another entirely. And that brings us to 11%. That is Eni's year-over-year underlying production growth in the first half of 2026. In an industry where major offshore projects can notoriously take a decade or more to come online, this level of rapid growth points to some profound execution excellence. They are demonstrating industry-leading time to market here, bringing these massive discoveries into production significantly faster than their competitors. And this brilliantly illustrates the core tension and the overriding strategy of the company right now. On one side, you have the massive, complex reality of offshore drilling and LNG processing. On the other, the sleek, rising infrastructure of a wind turbine. You can't just flip a switch and magically move from one to the other. It requires an incredibly calculated transition. Which brings us to Section 3, Engine 2, the transition. Executing the green transformation. This is where the profits from Engine 1 are poured directly into the future. And let me tell you, the momentum here is relentless. It's happening completely across the board. Under their Plenitude brand, they're launching major solar projects in Spain and acquiring Acea Energia.
Over under India Life, they are pushing massive biorefinery investments and acquiring entire service station networks outright. And in the UK, they are aggressively backing carbon capture, utilization, and storage with a new £500+ million funding facility. So they are expanding rapidly across solar, biofuels, and carbon management.
But they are also looking much, much further down the road. Beyond just solar and wind, Eni is securing the supply chain for the battery revolution by taking a 25% stake in a massive lithium mining project in Chile. And even more fascinating, and frankly kind of surprising for a legacy oil and gas major, they are actually investing in the nuclear fusion industry. They formed a joint venture to provide technical expertise for a tritium fuel cycle facility. I mean, this shows a company that isn't just looking at the next quarter. They are placing bold, strategic bets on what energy is going to look like decades from now.
Let's zoom out and see how this all builds over time. When we map this dense global portfolio chronologically, a crystal clear roadmap emerges. In 2026, they're bringing Congo LNG and the Baleine project online. Looking toward 2027 to 2030, they've got final investment decisions secured for major projects in the UK and Angola. And looking beyond 2030, they have long-term developments mapped out in Namibia and Australia. This pipeline is highly visible, folks, and it's targeting over 8 billion barrels of oil equivalent in production, extending well past the year 2030.
All right, final section, Section 4, cash flow and future guidance. Basically, the bottom line for value creation. So what does this all mean? How does this massive operational success actually translate to the financial health of the business? Well, because Eni's cash flow is so incredibly strong, they can comfortably confirm their massive €7 billion capital expenditure plan for the year that fully funds that dual-engine future. But simultaneously, they're rewarding their investors today, doubling their shareholder buyback program to a really impressive €3.4 billion. Basically, they're proving they can walk and chew gum at the same time, fund the green transition, and heavily reward their shareholders.
So the crucial point is that management is incredibly confident in the road ahead. They've upgraded guidance across the board, capturing upside in their global gas portfolio, raising guidance for Inaliv thanks to really strong biofuel margins, and upgrading their total cash flow from operations. And honestly, perhaps most impressively for such a capital-heavy business, they're doing all this while keeping their debt gearing at historically low levels, firmly parked in that 10 to 15% range. Upgrading cash flow while maintaining that kind of absolute financial discipline, that is a rare duality. Which leaves us with a final thought for today. We've seen the €8.9 billion operating profit, the massive floating industrial cities, the new solar farms, and those wild, bold investments in fusion. Eni is walking a serious tightrope, balancing a highly lucrative traditional engine with an ambitious green transition. But looking at these numbers, the real question is this. Can legacy energy giants successfully fund our green future using the profits of the past? Based on Eni's H1 2026 results, they are certainly making a compelling case that they absolutely can. Thank you for joining me on this explainer, and definitely keep your eyes on how this dual engine performs in the quarters to come.